We are officially live. Now, today, our main, okay, let me just get rid of all of this. Okay, let me just get a clean chart. Right, there we go. Now, if you're looking at the market, right, since I think the beginning of the month, our main focus or main objective has been to understand and be able to fully sort of like spot and identify what a proper breakout trade actually looks like. Okay, and I would say we are at probably at a 96% in terms of completion of it. Okay. Now, what will happen is obviously we'll go on through to the next sort of methodology that we are using, right? I know a lot of guys are really just anxious and ready to go and asking me questions about stuff we haven't covered because they saw it in the PDF. Guys, please just to be patient, okay? So if we haven't covered it already in the videos, okay, or in the previous sessions, then it's still coming up, so no need to worry about that, okay? Now, when doing your analysis, right, what we know is that the higher time frames have more of preference, right? So we can call it preference, or they are more reliable to us as opposed to the smaller time frame, right? If you're looking at the 1 minute time frame and you're trying to ascertain where the trend is, right, you can see on the 1 minute time frame that the trend looks like it's been down and then it just recently went up. But if you're looking on a monthly time frame, you see that, I mean, the price has been predominantly in a sideways range for quite a number of years, since 2015. So if you look at the swing low here, right, in 2015, I think, check 2016, yes. So the swing low from 2016, boom, the market made the swing low and then the swing high. The market is still within that range, right? So the high of 2018 and the low of 2016. So the market is probably at 50%. Okay. So this is 2,574 pips. Okay. So that is 1,650 pips. So that's probably about, let's just call it 50%. Okay, 50% of the move. So you can see that the market is still in sideways consolidation. Not a lot of trending going on, but I mean, with the GDP cap, don't really need it to trend that much in order for you to get some decent profits off it. Okay. Now, the importance of understanding time frames, okay, and not getting yourself lost, because I get this question a lot, and I can completely understand, because obviously when you get a trade set up, you want to validate it on all particular time frames in order to sort of like decrease your chances of getting the trade up. Okay. Now, looking at a lot of time frames, right? So looking at weekly, right? Starting off from monthly, let's say just go monthly, weekly, daily, 4 hour, and then 1 hour. First of all, doing that is a whole lot of work, okay? A lot of work that you don't want to get yourself involved in, because, I mean, once you recognize, or once your mind starts seeing that trading is a lot of work, you're going to try and avoid it as much as humanly possible. Okay, so if you feel like you're going to have to do 20 minutes of analysis on each and every single currency pair, right, each and every single day, then you're going to try and find ways not to do it as much as you should be. Okay, but if your analysis is about 5 minutes per market, right, that's much more manageable, that's much more simple. Okay, and then even if you reduce your market, so let's say you're looking at 4 markets at that's about 20 minutes of analysis per day, right? So the different time frames will always show you different patterns, okay? Because the smaller time frames comprise or build up to make up the larger time frame. So your daily time frame will build up and make and sort of like create the one candle of the weekly time frame, right? So 5 daily candles will create one weekly candle. Now this is important to understand because that means whatever the higher time frame actually shows us is comprised of what the smaller time frame has done. Okay. Now that means you can actually compress the amount of time you use or the time you spend analyzing certain markets just by looking at the higher time frames. Okay. Now I know if you've watched or if you've done analysis with me every single Monday, then you'll notice that I do go on through. I start off with the higher time frame. Sometimes I might even go as high as the monthly time frame because I just want to have a big picture overview. I don't want to see any surprises, for example. Okay, because a lot of times what would happen is you analyze the market, right? It looks good, solid on the 4 hour time frame, but when you go to a monthly time frame, you realize that there is a support right there. Okay, as soon as you sell, right, you sell there, but you're selling into a monthly support, let's say 2016 low. You don't want any of those surprises. So you start off with the higher time frames and then break it down to the lower time frames accordingly. Okay. So like I said, the monthly time frame can just be there for reference. What you want to do is to have those major levels highlighted on the higher time frames. Okay, so your major support and resistance, which would be those nice swing highs and swing lows. So pop, yeah, right, 84.43. Yeah, that's a nice resistance. We can see that the market has played around that zone before, broke above it, came back, retested, rejected, moved up, right, came back again, right, pushed up a bit, and then came back to break down. Okay, that would be a really solid um, entry that would actually have, right? This would be a nice, decent breakout for us, and the market rejects from that price level. Okay, so we can see that that is a strong level. Okay, I would just probably round it off to 80.50. Okay, so we'll just say about 80.50. Okay, anything around that 80.50 level, 8500, let's just say 8500 level is worth considering as a potential rejection area. Okay, because now we can see immediately, right, there's a swing high, the market changed direction once before there, and there is a probability that we might get the same outcome from there. Okay, now if you're looking at this swing high as well, okay, if you look back, you probably find that, okay, let me just get rid of this. If you look back, right, you can see it was a previous support structure. The market rejected price there once, right? Came back in 2001, rejected again, came back in 2004, 2005, I think, broke below it, okay, sort of rejected, and then came back and then was used as support again in 2006. It broke down, okay, and just missed that level again at, I think it was 2007 before the market started plummeting. So when you look at or when you find a strong or a daily, monthly, weekly support resistance level, most likely when you look back on your chart, you'll see some previous price action attached to that particular zone. Now that is something that we like to see, and that is something that we focus our attention on, especially when we're trading. So this doesn't mean that we're just going to be looking at these monthly or weekly support structures. Right, there's another swing low, okay, and the price doesn't look like it's been to this level, right? It's just reached this level in 2010, hasn't gone back there again. So with that type of thinking, then we have this sort of like big picture view of what the daily, the monthly, or the weekly time frame actually is, right? So we just keep these there, right? We don't need to move them off our charts, right? It's not like we're going to be trying to trade off that because it would be a very long time horizon, and I know a lot of guys don't really necessarily have the patience to trade on monthly or weekly or even daily time frames. Okay, but that doesn't mean you shouldn't have your clear bias on what the major directional move that you're anticipating and you're expecting should be. So now what we don't want to do is to play into these major zones. Okay, because if you go into your, since we're on the monthly, right, if you drop down through to, let's say, that weekly, we're going to see a bit more in terms of support and resistance levels. Okay, now in most cases, the weekly support and resistance levels will be more or less the same as the monthly. Okay, so if you're looking at the monthly chart, the same monthly or weekly support structures that are present on the monthly will be present on the weekly as well. So it's, you might possibly find one or two, okay, that are on the weekly, but it's more likely that you're going to find a bit more on the daily time frame than on the weekly time frame. Okay, so if you drop down to our daily time frame, okay, and we're just looking at the immediate support and resistance structures. Okay, now if you go to our daily, right, you can see there's another swing high, boom, right. You can see it acted as a previous resistance level. Okay. Okay, I think the price level, let's just round off to 7,800. Okay, so at 7,800, there was a previous resistance. Okay, there's a resistance that's actually up there, and should the price go close to this price level, we don't want to be buying right at that particular point. Should we wish to get into the market, we'd have to wait for the market to break out above the swing high, right? So it needs to break above the swing high, come back, retest, okay, and confirm an entry for us for a buy to the next support structure or resistance structure rather. Okay, so a typical scenario would involve the market pushing higher, right? Might rebound a bit from there, okay, and break above that 78 even level, 7,800, and then pull back into that zone and then continue on the move to the upside to about 87 or 8,500. Okay. Right. I trust that makes sense. Now, this is a very basic and very simple way of looking at the market in relation to the time frames. Now, if we go to our 4-hour time frame, you'll find even more. Okay, let me just remove this. Because on your 4-hour time frame, you're going to find more support and resistance levels there than you would on your daily, right? So if I zoom in, there's another support structure, right? There's a support, there's a previous resistance, right? There's another resistance that we had. If you guys remember this one, we actually caught this trade going up. And there is now currently a resistance level right over there. Okay. Now you find a bit more. So then how do you decide or make that decision to say, all right, I've got all these time frames to pick from, right? Now, which ones are the best or the ideal ones that I should be using in order for me to find the right directional bias? Now, the only way to know that for sure is to decide what sort of time horizon you're actually looking at. Are you looking to hold a position for the next 10 seconds? Are you looking to hold a position for the next 10 days? Or are you looking to hold the position for the next 10 months? Now, as a position trader, you will be looking at holding positions for a few months. Could be 10 months, could be 12 months, could be 3 years. You know, because I think for me, I think the longest I've held the position was probably like 11 months from February through to December, middle of December. Okay. So, and that was in the pound. Now, that is a position trade. So from there, you'll be doing all of that analysis on the larger time frames. You'll be using your monthly, your weekly, and your daily. Now, a lot of people don't realize that there is a lot of money to be made in position trading. We sort of have this bias towards short-term trading, which is scalping, which also can make a lot of money, but it's not the only way to make consistent profits, because you can short-term trade, right, and make some big bucks. But I would say, for me, the guys that I know that make like they're really big bucks and have like excellent risk control are the ones who trade in longer term. The guys who trading position trading for, let's say, they hold a position for 2 or 3 months or 4 months or even a year, right? And the guys who also bring in the numbers, but their stats or their performance isn't that impressive, I would say they are more short term oriented. Okay, they still bring in the dough, but they don't have the type of performance in terms of risk control where the drawdown is extremely low, okay, and the profit potential and the consistency of the profit of the upside is much higher. Okay. Now we'll go in through to this concept because I know a lot of guys have a really difficult time understanding what um, risk control actually is, or risk management. I've spoken about this quite frequently though, especially about the NASDAQ. You guys know how I feel about the NASDAQ and the type of accounts that you should have in order for you to confidently trade the NASDAQ. Okay, nothing less than $1,000 US. Anything less than $1,000 US is usually just a donation to the markets, because I mean those are very volatile markets, right? So it's a very volatile index, and more so, it is very aggressive. So on a very small trading account size, it's very difficult for you to manage risk. Well, it's almost impossible to manage risk, because it's either you have a very tight stop, which will be triggered, right, very frequently, or you have a very large stop loss or a reasonable size stop loss, but the loss is itself, the dollar amount in terms of loss, and the drawdown you'll experience is going to be too high. So 2 or 3 trades in the wrong direction out the game. So you don't want to be dealing in markets like that when you have a smaller size account. And when you get to $10,000, $20,000, $50,000, I mean, all of that stuff you will be able to do properly. But what you need to focus on right now is just ensuring that you have consistency trading the FX market, swing trading, position trading. I mean, you can short-term trade, but the main objective is to have your risk control down pat properly, and then you can choose to scale up and move up to whatever markets you want to trade. So, as I was saying, then your large or your long-term traders, all right, the guys who are looking at much longer time horizons. I mean, we generally at the monthly, the weekly, as well as the daily, right? So the daily is actually used for entries. Now, I know a lot of guys where they start their analysis off on the daily and then move down. So if you have 3 time frames that you're actually using, they need to be right next to each other. For example, if I'm going to be trading on, I'm looking for an entry on the GBP CAD, right, for the next 3 or 4 months. It's always advisable that you don't just go from the monthly time frame and then go through to the 4-hour or the 1-hour time frame. All right. You'd like to have the monthly, right, time frame. You do most of your analysis there, and then some analysis on the weekly, right, just to confirm what you've been doing. And then on the daily, that's where you have your entry, right? So likewise, if you're having short-term trades, you'd like to look at your daily, for example, then your 4-hour, and then your 1-hour is going to be for the entry. Okay. So all of that needs to be in the game plan, right? So the trading plan. I know a few guys who sent the trading plan to me, okay, and I did respond. I think to almost everyone. I think I did respond to everyone who sent me their trading plan to take a look at. Some I was extremely impressed, right, with the amount of detail, and some I was not so much impressed in terms of the it's just that guys sort of like copied and pasted the template that I actually sent out, right? So my trading plan from a while back, I posted it up, and guys just sort of like made an identical copy of that and just changed a few things there. Right now, we're gonna have to redo that again, okay, for most of you guys. But if I sent you a response saying that yours is fine, then no need to worry about that. But the trading plan then needs to detail the actual um, time frames you're going to be utilizing. So I wouldn't suggest anything 30 minutes and below. Okay. Now, especially if you are still relatively trying to find your feet, because like I usually say, swing trading, right? Swing trading, a lot of guys get sucked into day trading and just want to be active in the markets every single day. But swing trading, from my experience, has been proven to be more or simpler and easier for guys who are new and actually came into the market. Okay, especially if you're working and stuff like that, you don't have the time and you don't have the the facilities around you at work for you to constantly be on your charts each and every day. So you want to have a time horizon that actually fits your schedule, right? And fits sort of like the amount of time that you are willing to allocate to trading. Because I can assure you that day trading takes a lot of time, takes a lot of energy, and takes a lot of mental focus, right? Uses a lot of glucose from the brain. So you have to focus for long periods of time. And even so, it doesn't guarantee that you're going to be making money, right? You want to have a methodology that is simple, right? Straightforward, something that works for you and the amount of time you're willing to allocate to your trading. So what I usually say then at a position level, looking at your monthly, your weekly, and your daily, right? If you're looking to swing trade, right, looking to get trades in for 3 or 4 days, 5 days, maybe a week, you're looking at your daily, your 4 hour as well as your 1 hour time frame. Okay, that's going to give us a really good, decent idea of where the market is going. Now, if you are short term, you adamant, you feel like, yeah, short term is going to be for me. I want to hold trades like just for one day. I want to get in the morning and get out during the course of the day, right? Then I would say you should always look at least at your daily, right? But your analysis will be drawn in from your 4 hour, you'll be using your 1 hour, and then your 30 minutes. You don't really want to go below 30 minutes in your analysis. I know a few guys we've spoken, and when we did speak, I did suggest they can use the 15-minute time frame. But I mean, after doing a lot of research on it, I mean, it doesn't feel good to me, right? So rather, if you want to focus, right, focus on those three, right? As a short term day trader, looking at your 4 hour H1 and your 30 minute. As a position trader, it's your monthly, weekly, and daily. And as a swing trader, you're looking at your daily, your 4 hour, and you don't do any analysis on the last time frame. Really, it's just in for confirmation. If you're looking for a rejection candle, for example, like this, right? Or let's say what we're looking at right now. Let me just make an example here. Right, what we're looking at, that is not where we're looking at. Okay, you see there, yesterday's low, market broke below that previous low, boom, made a swing low there, came in to retest the low. Now we'd want to see a rejection candle, right? We're not entirely convinced of this one, so we'd like to see a rejection candle moving away from that area in order for us to short the market. Okay, this is something that usually happens a lot of the time. Okay, you have previous swing low point, right? Market breaks below it and comes back to retest the area. Now, obviously, a few more things need to come in together, right? A few things need to come together in order for us to confirm that this is a trade, but structurally, the way we're looking at it, we can see, all right, there's potential for us to get into that particular trade. Okay. You guys are good. Okay. Are there any questions? Okay, the session is being recorded. I'll upload it during the course of the evening and then send through the link in the Telegram channel. No need to worry about that. And I will send the video for the trading plan tomorrow morning. Right, I'll send through a link, and you guys can just watch that and sort of like get started on. You don't have to actually do it, right? You can just have an idea. So when we get to it, it's going to be much, much, much easier for us to get through it. Okay. All right, we literally have a few minutes left. So I'll just be taking any questions you guys might have. Like I said, with the guys who didn't have the session today, because I actually did do the beginner session yesterday. It's supposed to be yesterday, and we did go through it, but we didn't have enough time for us to finish. Or my Android emulator wasn't working because I wanted to show you guys how to log into the MT4 platform on your phone, place trades, place stop losses, partial execution, all of that stuff. But the software I installed on my laptop wasn't responding, so it was just taking an age. And I decided to just do it directly from my phone today, of which my phone, when I tried to install Zoom, wasn't responding well. Okay, so, but I will be recording that later this evening, okay, offline, and just upload the link in the Telegram channel. So if you guys have any questions, anything you need me for, just drop me a message on Telegram or WhatsApp message, okay? You guys know the digits. And I will be seeing you guys next week. Got plenty of stuff that I'll be sending through the Telegram channel. Right? So you guys look out for that. Some research you guys should be going over during the course of the weekend, and some watching of some videos that I put together for you guys to sort of like coming through on Monday. When we come through on Monday for our market preview, you'll be able to go over. Okay. All right. Yeah, you can speak now. Michael.
Sorry, I made a mistake. My phone.
Oh, okay. No problem. No problem. Okay. So, guys, yeah, just make sure then to watch the stuff through the weekend, right? I'll send everything through tomorrow, but tonight I'll only send the recording of this video. And I hope you guys have a wonderful evening, and I'll check you guys next week. Right? Cheers.